I'm going to do a quick video here on automated portfolio trading. I put up a video earlier of how I trade institutional FX, trading fully automated in 12 to 16 instrument portfolios, and how I've done that for basically a little over 9 years now. So let's get into portfolio-based automated trading. And I get lots of emails all the time, especially over the summer months and even building now on gold, gold, gold. I want to trade gold. Well, hey, gold's fantastic to trade. If I couldn't trade the NQ or MNQs, I'd be trading gold right now, and probably Bitcoin futures too. So I'm going to show you gold first, and then I'm going to show you Bitcoin futures. But the same mentalities and the same structure to how you could work automated portfolio trading is exactly the same whether you do this in a portfolio of, let's say, of FX pairs and CFDs, or if you're trading, FX instruments or certain commodities on the future side, or if you're trading crypto, like spot market crypto through maybe Kraken or some other exchange. You can do this same approach in any of the markets. This approach works fantastic in FX, works fantastic on commodities, works excellent on crypto. So here's gold. This is kind of be close to a time frame I would typically trade, and it's pretty simple. Let's go back a bit, and it's like, hey, all these indicators have full outputs to be utilized for third-party tools. So when I get a certain signal that we typically would use for a reversal, now these vertical lines just mean that the upper fast band has now closed inside the main band. And this is off a little bit because the data starts right here. So actually we'll ignore that one, because really the band would probably be more like this. So anyhow, we'll skip it there. We'll go to this where I can tell there's at least been enough data come through the chart. But there's a certain condition we look for when we do reversal trading. So if I get in a long trade, say in this area price, the first time we pass through the mid band, we typically take about 55% of the position off. The way we have it optimized, we have ours optimized for hyper smooth equity curve. If I was going to go for a higher return optimization where the equity curve is more jagged but greater, I would take only a third off here and hold the other 2/3 to the other side of the bands. But when you're trading substantial size institutional accounts, the clients you trade for, whether it's your own fund or in our case, like being a trade desk for hire, like whether it was an investment bank group or a boutique hedge fund, says, hey, our system's dead, or we don't have a system, but we have a fund, or we can set up a fund. We need a system. We need somebody to be at the trade desk, do all the trading. Well, that's what we do. So info@gridalgo.com if you have questions on portfolio-based trading. So we'll trade, and the way we do it is we like to do about 7 to 9% monthly return, but we want the equity curve to look like that, from beginning of a month to the end of the month. So because in the end, if you wanted to, you can trade size on a really smooth, stable equity curve. If your equity curve looks like this and you get the same result, but that's nerve-wracking, especially when you're trading around the clock, basically Sunday night markets open all the way through Friday afternoon close. And then you're holding over the weekend. Holding over the weekend's easy. That's so easy to hold over the weekend and hedge your portfolio during the downtime if you need to. So the idea is to optimize for a very smooth equity curve as the bias. And platforms like TickBlaze, you can do portfolio optimization, and then you can set the bias to, like, okay, show me, with all these different bar type settings, like time frames, dialing in the time frame, then hey, for the super bands indicator, all this stuff you look at in the optimization, what is the best settings to give me the smoothest overall equity curve? Then when you get that figured out, then you can go in and say, okay, how much position size would I need to trade per instrument, per entry, looking at all the data to get from here to here month after month and do about 7, 8, or 9%. It seems mind-boggling. That's a lot of money each month. Now you can do, you could trade abnormal size and say, oh, I want to make 15% a month. That's up to you. I'm just saying, when you trade for an institutional client, they want safety, not max returns. And they're used to making 1 or 2% a month. So they start making 7, 8, or 9, and they see how stable the equity curve, they're like freaking out. They love it. So why go try and make 15%? Just play it safe and smooth. Okay, so the idea then is even using third-party tools, determining what is your entry point, whether, using the cross, the signals within the indicator. So let's just say use the cross signal. So you're long, get to mid-band, the first push through, take a portion of the trade off. You're in the trade, you're in the trade, you're in the trade, get across. The longs are flat. Now you're short. Go to mid-band, take some off. You're in the trade, you're in the trade. Okay, you get across. The short comes off. Now you're long. Mid-band takes them off. Other side of the trade, you get confirmation of a flip. Now you're short. Longs come off. Now you're short. Okay, now you get across. Shorts come out. You took some off at the mid-band. Now you're long. Now you're long, you're long, you're long. Some came off right away at the mid-band, but the remainders you're holding, 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 holding. And this is what happens with these type of setups. When markets get into hard trends, it happens all the time. We'll get an entry. Part of it will come off about typical amount of distance. In this case, it came off right away. And then the other portion is in for like day or 2 or 3 or sometimes 4 days. And then we get an excursion, then we go flat. It's like, woohoo, that was a nice one. So those are days when your super smooth equity curve will have a little bit of a bump in it, and then it'll get super smooth again. Then you have it'll have these little bump up lumps in the equity curve. But in the end, it's super smooth. It's not an equity curve. You're taking drawdown and up and down and up and down. And the beauty of trading this way as a portfolio, you're never really in a lot of positions ever that are underwater, at least anything significant. So you might have a situation where, you're short, and then let's say you get a pullback, and let's say it misses the midband, it goes up and gives you another short. So now this one's underwater a bit. This one's pretty much at cost, and it comes down, eventually hits the midband. Parts of both positions come out, you wait, and then finally you cash out. So, yeah, do you have parts of the portfolio that are underwater? Not very much. Usually it's like 5 to 7% of the portfolio is underwater. The rest of it's all at money or in the money. So if I'm holding a position from here on one instrument and it's way up here, so I have all these, positions that are way deep in the money waiting to get cashed out on excursion. The other part of the bands, you might have some new trades initiating in some other part of the portfolio that are a little bit underwater. But you have the predominance of the platform are positions that are a little in the money, medium in the money, or deep in the money, waiting to finally get that cash out. And that was happening with yen pairs. We had trades in yen pairs that were so deep in the money that I was just going and cashing some of them out. Like, my gosh, I got 4 trades on that had been in, short or long, depending what currency pair it was, for weeks. It's like, I'm just booking it out. I don't want to keep that as unrealized gain. Let's book it out. We're way up for the month. The most I've ever done in a month, trading very substantial amounts of money for an institutional client, I had 1 month once the system did 19.2% in a month. It's just like everything was moving, and then some of them were having really big moves. So a significant part of the portfolio had many, many positions going deeper and deeper and deeper and deeper and deeper in the money. And then I got kind of to month end and I just booked a whole bunch of stuff out and said, okay, I'm taking that off table. I can't believe we did this much in a month. So that was like May of, God, what year was that? May of 2022. I don't know. It was, let's see, the war started in Ukraine in February. I think it was that May. For whatever reason, there was a month that 19.2%. Now I'm used to stuff in the sevens to 11s, like clockwork, slow, dead months, 6, 7, normal months, 7 to 9, wild months, stuff moving all over, up, pushing up around 11%. And then a few outliers where I've done 12.8 1 month and 19.2 1 month. So since then, I've got newer versions in the bands that are more precise. So my bias has been to make the equity curve even more flat, meaning or the equity curve having less bumps on along the way, just super stable equity curve from beginning the month to the end. So I mean, this is like a turnkey, go start your hedge fund way to trade. It's not that hard to figure out how to do this. You got to have the right tool though. So then, then we're short, takes them off at mid band, no qualified reentry, you're still in, now you're flat, now you're long, now you're short, some off at the mid band, back in, some off at the mid band, you're holding your remainders till something else happens. So let's go take a quick look at Bitcoin futures. You can trade this same style with a full crypto portfolio. You're short, takes them off at mid band, other side cash out shorts. Now you're long, takes them off at mid band, holding, holding, holding. Now this is one where you're holding, holding, holding. Okay, cash goes out. Now you're short, takes them off at mid band. Then heck, we had a run in Bitcoin because I've incorporated Bitcoin into the portfolio. There was the long. Long, right away got some off at mid-band, and then it's going and going and going and going and going. Finally cashed out. Short takes them off at mid-band, take off the rest. Long, long again, takes them off at mid-band, short, short to, and so on and so on and so on. So crypto portfolios have wider daily ranges. Holy cow. You can do 11, 12, 14, 15% months with the right tool like this, but optimize in a portfolio of related, of crypto instruments. So this is what I call automated portfolio trading. And it's not that complex to set up a portfolio and trade this way. But you better have the right indicator because the indicator is the engine of your strategy and your trade. And you don't want to be using TMA bands that recalculate and repaint. You can do this type of trading there, but the optimization work is painstaking and you have to do it like every 90 days over because everything changes. It's shocking. I can optimize at the beginning of the year, a year later optimize, and the settings almost don't change at all. And it's, this newer version of the 7th generation of these super bands that are not TMA bands just work fantastic for defining the dynamic range of running markets. And then it can be utilized to determine areas to be a buyer or seller in a simplistic design automated system to trade a portfolio. So if you have questions specific to that type of trading, you can always contact me directly at info@gridalgo.com. So there you go for all the questions I got. Try to answer them all. You guys have a great night. And I'll be ready for trading tomorrow. We'll see what we get.